Israel's defense stocks are booming, war is fueling profits. But here's the real question: should you invest? Geopolitical tensions are skyrocketing, military contracts are surging. Israeli defense companies like Elbit Systems and Rafael are in the spotlight. Global demand for cutting-edge defense tech is through the roof. We've seen this before. US defense stocks soared during Iraq and Ukraine conflicts. Defense is one of the few sectors that often gains in war, but these spikes are typically short-lived. It's not all upside. High volatility plagues conflict zones. Ethical concerns loom large. Profiting from war, it's a moral minefield. International sanctions or sudden political shifts could derail gains. So, how to play it? Direct investment, ESLT Elbit Systems or ETFs with defense exposure. Indirect route, US-based defense ETFs like ITA or DFNS, or skip defense entirely. Consider peace-focused ESG funds. Profitable, maybe, ethical, you decide. Either way, invest with eyes open, not just dollar signs. Let's dig deeper. Israel's defense industry is a powerhouse. It's built on necessity, innovation, and decades of conflict. Companies like Elbit Systems aren't just selling weapons, they're exporting high-tech solutions. Drone technology, cybersecurity, advanced radar systems, global instability is driving demand. Not just in the Middle East, Europe, Asia, even the US are beefing up defense budgets. Israel's battle-tested tech is in high demand. But it's not all smooth sailing. Defense stocks are notoriously cyclical. They boom during conflicts, then often bust in peacetime. Timing is everything, and timing war? It's a fool's errand. Let's look at the numbers. Elbit Systems ESLT saw a 30% spike in share price since October. Impressive, right? But zoom out, over 5 years, it's only up 15%. Defense stocks can be a roller coaster. Historical context matters. Post 9/11s, US defense stocks surged. Lockheed Martin doubled in value, but by 2002, the gains fizzled. Same story with Russia's invasion of Ukraine. Initial boom, then a plateau. Ethical considerations can't be ignored. ESG investing is on the rise. Many funds explicitly exclude weapons manufacturers. It's not just about morals, it's about long-term sustainability. War might boost short-term profits, but peace is better for global economic growth. There's also the risk of backlash. Companies profiting from conflict can face public scrutiny, boycotts, negative press. It's a PR nightmare waiting to happen. Political risk is real. Government contracts are the lifeblood of defense companies. A shift in power, a change in foreign policy, it can all impact the bottom line. And in volatile regions like the Middle East, change is the only constant. So what's an investor to do? If you're bullish on defense, consider diversification. Don't put all your eggs in one basket or one conflict zone. ETFs offer broader exposure. The iShares US Aerospace and Defense ETF ITA tracks the entire US defense sector. It's less volatile than single stock picks. The SPDR/S&P Aerospace and Defense ETF XAR is another option. It's equally weighted, giving smaller companies more representation. For those focused on Israel, the Blue Star Israel Technology ETF ITEQ includes some defense exposure, but it's not a pure-play defense fund. It's tech-heavy, reflecting Israel's broader innovation ecosystem. Want to avoid defense altogether? Look into peace-focused ESG funds. They invest in companies promoting stability and sustainable development. It's a long-term play, but one that might help you sleep better at night. Remember, investing in defense isn't just about numbers. It's about geopolitics, ethics, and long-term trends. The world is moving towards more sophisticated, high-tech defense systems. But it's also pushing for peace and sustainability. Israel's defense industry is at this crossroads. It's leveraging cutting-edge tech for military applications. But many of these innovations have civilian uses too: cybersecurity, drone technology, advanced materials. The line between military and civilian tech is blurring. This dual-use nature presents opportunities and risks. On one hand, it diversifies revenue streams. On the other, it complicates ethical considerations. Are you investing in weapons or innovation? Let's talk volatility. Defense stocks can swing wildly on geopolitical news. A peace deal, stocks plummet, a new conflict, they soar. It's not for the faint of heart. You need a strong stomach and a clear investment thesis. Timing is crucial. Buying at the start of a conflict might seem smart. But remember, markets are forward-looking. By the time you hear the news, it's often priced in. You might be buying at the peak. Long-term trends are key. Global military spending is rising. But so is the push for peace and diplomacy. It's a delicate balance. The most successful defense companies are those adapting to both realities. Innovation is the differentiator. Israel's defense industry isn't just about traditional weapons. It's about AI-powered systems, autonomous vehicles, advanced sensors. These technologies have applications far beyond the battlefield. Consider the broader economic impact. Defense spending can boost GDP. It creates jobs, drives innovation. But it also diverts resources from other sectors. It's a complex economic equation. Regulatory risks are real. Arms exports are heavily regulated. A change in policy can shut down markets overnight. It's happened before. It'll happen again. Don't forget currency risk. If you're investing in Israeli stocks, you're also betting on the shekel. Currency fluctuations can eat into returns or boost them. It's another layer of complexity. Due diligence is crucial. Look beyond the headlines. Dig into financial statements. Understand the contract pipeline. Defense deals are often long-term. Today's conflict might fuel tomorrow's profits or losses. Consider the competition. Israel isn't the only player in defense tech. The US, China, Russia, they're all in the game. Global competition is fierce. It's not just about who has the best tech. It's about geopolitical alliances, trade relationships, and strategic interests. Think about diversification. Defense stocks can be a hedge against geopolitical uncertainty, but they shouldn't dominate your portfolio. Balance is key. Mix in other sectors, other regions. The bottom line, investing in defense stocks is rarely or otherwise is complex. It's not just a financial decision. It's a moral one, a geopolitical one. It requires careful thought, thorough research, and a clear understanding of your own investment goals and values. Profitable, it can be. Ethical, that's for you to decide. But whatever you choose, go in with your eyes wide open. Understand the risks, the volatility, the potential for both outsized gains and steep losses. In the end, the decision to invest in defense stocks is deeply personal. It's about more than just returns. It's about what kind of world you want to invest in, what future you want to support. So should you invest in booming Israeli defense stocks? There's no one-size-fits-all answer. It depends on your risk tolerance, your ethical stance, your investment horizon, but now you have the context. The risks, the potential rewards, the bigger picture. Make your decision wisely, invest responsibly, and always do your own research. Because in the world of defense investing, knowledge isn't just power, it's profit and peace of mind.